Let's do it. I just real quick introduce you guys. So
Okay.
these are the Sherwood guys. Steve Loebner, a lot of you guys know Steve and have worked with Steve or talked to Steve in the past. Kyle Little and Michael Goodman, and Sherwood, I think, did one of these a little more broadly that some people got some invitations to. And I had a few people asking me about this forward pricing and risk management presentation that they do. Steve had offered to just do one for IdaPac, so that's where we are here today. We have used Steve for forward pricing any number of times. It's a tool that's out there, and he's going to go into some detail. And for some of you guys, there'll be some familiarity. For some, it'll be probably a little complex, but let's get the ball rolling and appreciate it, guys.
Yeah, no, thanks, Scott. Yeah, Scott mentioned, you know, I've already dealt actually doing business with quite a few of you folks, and a bunch we're not. So briefly, what we're gonna try to move this along pretty quickly today and have it hopefully as interactive as we can. So feel free to ask questions as we go. So briefly, I'm going to go into Sherwood Lumber just to kind of, you know, for those of you that aren't familiar with us, we'll talk about who we are and what we do. It's going to be myself presenting, and then also Kyle Little, who is our COO and also heavily involved in futures and hedging. So the two of us are going to kind of walk us through this thing. So actually, Kyle, why don't you just introduce yourself real quick?
Thanks, Steve. Thanks, Scott, again for setting this up for us. Great to see you guys. I know I've met some of you. Steve and I had an opportunity to meet with some of you back in Oregon about 18 months ago. It seems like now, which seems like a little bit forever. But my name's Kyle Little. I'm a Chief Operating Officer at Sherwood Lumber. I've been in the industry now for over 20 years. The last it'll be 12 years in April here at Sherwood Lumber. I've taken on a variety of different roles in the industry, working both retail, buying group, brokerage wholesale, and then now here at distribution and brokerage wholesale at Sherwood Lumber. Grew up trading or started trading SPF and inland species, but really cut my teeth in trading Eastern and Western Canadian SPF over almost a 15-year period before I moved into more of a management type role in the last 4 or 5 years. But started here at Sherwood as just a lumber trader and did a lot of variety of different roles, and now have taken on the leadership role in the organization, and happy to work with talented people like Mr. Loebner, who challenged not only me, but the rest of our organization and the industry with creative ideas to go out there and push off risk in a highly volatile environment. I don't think any of us would have expected the market to be as volatile as we've seen over the last, let's say 2 years, 3 years since 2018, but it is. And I don't think it's going to change much as we move forward, and having the opportunity to provide options for people, our clients, it's something that we really pride ourselves in, and very excited to speak to you guys today and see what opportunities or questions you might have, and see how we can fit solutions to alleviate some pain that might have experienced in the last 12 to 18 months. Thank you, Steve. Just remind everybody as we're talking, if you can, try to stay on mute, just so there's not a lot of feedback for the rest of the guys talking on it. We definitely want to get feedback from you, but just if you can, for the majority, until you speak, stay on mute. Back to you, Steve.
Thanks, Kyle. Yeah, so for those of you who don't know me, you know, I head up the risk management, you know, and forward pricing division at Sherwood. We're doing predominantly, you know, dealing with multifamily guys, doing long-term pricing, really coast to coast. Been running that book for over 5 years now. I work in our Portland, Oregon office. We have a 9-person trading floor here, and I run that as well. So also buying and selling cash every day, just, you know, doing the normal broker duties also. So, you know, a lot going on, and, you know, keep me busy. go to the next slide here. Just briefly, we'll be real brief. Kyle, tell them about Sherwood here briefly, and then
Yeah,
we'll move
for those of you who don't know, I think a lot of people already don't know who Sherwood is, but we are a family-owned and operated lumber wholesale distributor. Are based out of Melville, New York, which is in the, for those who don't know where that is, it's the center of Long Island. It's currently where I'm at today. We have 95 employees across the country. We sell primarily commodity lumber and panels. 95% of what we do, 5% would be building products. Hey guys, can you guys put your phones on mute if you're not talking, please? Thanks. Sorry, Steve, you muted everybody, including me.
Yeah,
so sorry.
Sorry about that, guys. All right.
No worries. I just took it. So our annual volume is just over 800 million board feet / square feet. 70% of what we do comes out of our distribution center, and encompassing of that 100%, we're producing or servicing our customers on our risk management side, either through our distribution footprint or through a brokerage footprint, where we'll set up some of that where areas that we don't cover on the brokerage side. So just to give you an idea, we sold in 45 of the 50 states in 2019 and also in 2020. I haven't updated that. And centers across the United States. If you're all on the Eastern Seaboard and the Gulf Coast, with the influx of European product that we're now handling into those markets. That's about it.
All right, Kyle, you're kind of cutting in and out there, but basically here's the schedule of what we're going to talk about briefly today. First we're going to talk about obviously why we want to hedge. That's sort of, obvious based on what's been going on the last year or so. We're going to discuss some of the, advantages and reasons why we want to consider it. Going to talk about sort of our philosophy when we do these trades, and it is different. It's different than how a lot of people have bought in the past, using futures and forward pricing. So it's important to talk about kind of the philosophy and the kind of the mindset behind it and how it ties into your overall business, so everything works together. We're going to have a brief, discussion on the tools. Essentially for those of you guys that don't know, what is forward pricing? What are swaps? Buy and hold. We're going to talk about some of the advantages and disadvantages of using all these different things and some of the nuances involved. Talk about some of the common questions that that come along with doing this sort of thing, and hopefully answer those. And then there's a lot of things to consider just to get the most out of doing a program like this, and things that you want to look at and evaluate for doing these things and having them work the most effectively. So we're going to discuss that as well. And we'll finish up with sort of our current market read. We do a lot of analysis, obviously, about what the trends are and what we foresee happening, and we'll just sort of give you our 2 cents there. I know you guys are doing that every day as well, but it'll be just sort of interesting to compare notes on that. I'd love to have some interaction and hear your guys' thoughts as well, and so we'll have an open discussion hopefully of anything that comes up along the way. If there's questions, definitely make a note. We want to answer any questions you guys have as we go. So that'll be the agenda. Okay, why hedge? This first quote's kind of silly. It's from this cheesy 80s movie, Big Trouble in Little China. I'm a reasonable guy, but I've just experienced some very unreasonable things, right? And that sort of sums up certainly the last year and really the past few years. So, I mean, hedging is becoming more and more important, based on essentially the crazy volatility of this marketplace, and helping people to mitigate risk and manage through these times that are, that are unprecedented, that none of us have ever experienced before. So I think understanding the different tools that are available and knowing how to use them at the right time, it's just another competitive advantage that we need to have. The second quote here, I really like it. It's from Paul Tudor Jones, is a hedge fund guy, a big hedge fund trader, has been very successful. And he says, at the end of the day, the most important thing is how good you are at risk control. 90% of any great trader is going to be the risk control. And I think that's really accurate, and certainly in my trading and the stuff I've done, it's really borne itself out is, when it's smooth sailing, calm seas, the winds at your back, it's like, it's easy to look like a hero, but when we're going through these crazy, insane times is really what, that's what separates, the real winning strategies from the rest, because it was when things are bad, not when they're good. And so I think that's really important when you're talking about risk control and hedging, is that really will it's a tool that can help, eliminate having those big drawdowns, which are not, I don't have to tell you guys, it's not fun. So the main reasons, obviously, we're reducing risk. That kind of goes without saying. Having more predictable earnings and volatility. We're not making a fortune, losing a fortune, up and down, crazy. We're trying to have it be, steady, consistent, profitable over the long run through all market environments. So that way we can, hopefully sleep at night and, cut down on our, alcohol bill. So that's important there. Obviously, hedging can help you lock in profits using forward pricing and some of these tools. Timed correctly with the market, you can, lock in a lot of great margin and put a lot of risk to bed in a very cost-effective way. I think the people that use the program really well understand that if you use this stuff correctly, you can actually do a lot more business because your dollars aren't at risk. You're locking in your margin. You're moving on to the next one, you're doing that one, and you just don't have the worry, that you might get, annihilated in some crazy environment like what we're going through. So it's really important from that regard as well. And I think that doing it correctly, initiating the program right and doing it all the right way is going to not only reduce your volatility and give you earnings predictability, but I think you'll make more money too over the long run, because there's certainly some nuances and some things that we can help with where you can actually add to your P&L over time. So. Okay. So we have to kind of have a philosophy that's going to guide us as we move along this path, because it is different. I mean, when you look at futures-based hedging, it is a different game than just the traditional, playing the cash market and using reloads and stuff like that. So I think you have to have a kind of a philosophical underpinning of like what you're doing and why. And so this is sort of ours. I mean, we're probably one of the most active companies in the futures market. So we've really been doing this a long time through ups and downs. And so this is our philosophy is, we think that in the long run, when you're looking out 6 months, 8 months, where a lot of these jobs are priced, we don't think anyone can really outguess the market that far down the road. And I think history has borne that out. If we took in a survey this time a year ago, I mean, no one would have ever thought in a million years we'd be doing what we're doing. I certainly wouldn't have. No one could have. So I think, once we realize that in the long run, when you're looking at markets, months and months down the road, once you kind of understand that really we don't know what's going to happen. We all have ideas and sometimes we're right, but in the end of the day, we don't know. So that's important, because then you can open yourselves up to like, okay, given that I really don't know what's going to happen, you can look at all the, potential range of things and figure out how to mitigate your risk better. I will say that most of us are pretty good at the short run. Certainly you guys are experts. The intermediate run, I think we're all pretty good at that stuff, but a lot of the business we're doing, is 6 months down the road, 8 months down the road, a year down the road. No one has a clue what's going to happen a year down the road. So it's important to understand that. We think it's important to always hedge some degree of your risk, but we definitely vary that amount based on market conditions. Certainly when we're, down in the trough, the market's really cheap, we're going to hedge a lot more of your upside risk than, up in here, it's questionable because we really are, the paradigm's changing, but, traditionally when you're at the higher end of the range, you wouldn't hedge as much, although that's changing now with the hyper volatility we're experiencing. But essentially, we believe always hedging some degree of your risk, but varying it based on conditions. And really, we look at this kind of over the long run. We're measuring our results over quarters and years, not trade by trade, because when you do hedge, you will smooth out the volatility, meaning you're not going to get annihilated on the upside. You're not going to lose money, right? But when the market completely falls apart, you're not going to hit that grand slam home run either on that portion that you hedged. So we just think over the long run, when you smooth all that stuff out and you produce steady, consistent, very good returns, that's kind of what it's all about. And so that's sort of, how we view things there. We look at a lot of different things for our forward pricing and our analysis. Really, it's everything kind of coalesced together. We're really big into correlation analysis, where we look at the correlation between all the different items that we price, and we can get into that in more detail later. We're big into technical analysis. I think it's important. Obviously, fundamentals and what we're seeing in the marketplace and all that stuff is very important too, and just trying to gel it all together. So we have a pretty sophisticated modeling system that we use to basically help us arrive at these forward price numbers, and it incorporates a lot of different data. And really, the net result at the end is just to sort of keep a steady hand, through all these markets and environments. I mean, it's crazy. It's like, it's easy to kind of go off the heat of the moment and the feel, and I think that is very important for the short run trading. But when we're making decisions that are going to impact us for 6 months or a year down the road, I think having more of a kind of a model-based framework that is less less about like gut feel and more about some of the using some of the science that's available, I think is really important. So that's the philosophy that we use. And of course, the tools that we offer to you guys, the main tools, forward pricing would be the certainly the most prevalent. Forward pricing, for those you don't know, we're essentially selling you at a fixed price for future delivery out to 18 months into the future. We've gone out as far as 2 years in the past, actually. So essentially, we're looking at a specific a price, ship time, what the items are. Essentially, we can price everything, almost everything, lumber based on that's on random length front page. So that's 2x4, number 2 pine. It's hem fir, it's green Doug fir, and we have jobs going all around the country, everywhere from Florida up to Washington State. And so we essentially, it's not just on Western spruce. I mean, futures is the tool that everyone looks at. Obviously, futures is traded on the Chicago Mercantile Exchange. It's specifically on 2x4 number 2 Western spruce. That's what futures are on. And that's what it tracks. But what we use our modeling and our data to essentially arrive at at prices for all these other off-species items, which are the main items that people are interested in. So that's forward pricing. And that's probably 95% of what we do in terms of risk management for people. That's what we're known for, and obviously have one of the biggest names doing it, and we've been doing it a long time. Swaps is really a similar concept, but it does not involve physical delivery. So it would involve a specific item, a specific ship time, a specific price, except instead of actually shipping you the lumber, we would just take the difference between the price we arrive at and where the market is at that time, and we would exchange money. So if, for example, if you bought studs at 900 on swaps and the market's 1200 at come ship time, then we would send you a check for $300 a thousand. Vice versa, if the market's lower, you would send us a check. So why would people do that? A lot of folks like it because it enables them to still be in the market buying from their normal suppliers. They're still buying the physical lumber, but now they have this financial overlay that is like that'll give them protection, essentially lock in a price but they can still be active in the marketplace. So swaps is one that we do as well. Not nearly as much as forward pricing, but it's a big deal. Of course, buy and hold, you guys are very familiar with this. This is, I think, the traditional kind of, one of the traditional tools that the guys use is, you got jobs starting in 4 months, the market's bottomed, it's time to go, buy a bunch of cars, put them in the reload and ship them when the job goes. I mean, that's kind of I don't have to explain that. But the only thing I would caution there is to consider all the costs that are associated with that. You're going to have to write a check for $100,000 a car, or $10,000 a car, or whatever, potentially a whole bunch of cars, sit on them for several months, pay storage and interest, maybe have product degradation, maybe not. But there's definitely a cost to doing that, versus a lot of times using the forward pricing model, you can essentially secure that same price, sometimes cheaper, and have it show up exactly when you want it and pay for it when it ships. So that's a big advantage. But the buy and hold is very important, and it's not going away. So here's some of the common questions that go along with forward pricing, and I'll just kind of run through them. What items can we quote? Again, it's most of the lumber items that are listed on Random Length front page. It's pretty much all species, all the bulk commodity, framing items, studs, plate, all the basic bread and butter stuff. We don't do this on like timbers. We can't, panels don't work. There's no correlation on panels. Unfortunately, I wish there was. When you get into oddball stuff, specialized tallies, odd trims, it sometimes becomes challenging because the modeling, we don't have the data to really to look at that stuff. But we can quote most of the big, bulk items that are on these jobs that you guys are quoting. We can go out as far as, a couple of years. Most of the jobs we do are probably, I would say average is probably 4 to 8 months out, but we have some guys that have gone out as far as 2 years. This is a big one. What if the job ship time changes? Job gets pushed back. Obviously, it happens all the time. So in that instance, typically, as long as we're having close communication, a lot of times we can just adjust our ship time to suit what the job does. It really depends on a lot of circumstances. What futures are doing, we'll have to roll our position. So it depends on the different futures months and what that spread is. There'll be certain times where we might have to charge a little bit more. There'll be other times where it won't cost anything. But the beauty of it is as often as jobs do get pushed back, this is something that we can work through, and typically there's not a big cost or anything associated with that. Versus if you were sitting on the lumber, now the job's 4 months down the road. I mean, that's you're paying storage interest for another 4 months on a lot of money. So it's definitely an advantage. What if the market falls? So the market goes up or down, the price is the same. It's fixed. It's fixed pricing. The way that we are able to do this is we're hedging our risk using the futures and options market. So we're not just shorting the market, we're taking offsetting positions to hedge ourselves. So, in theory, the way this works is when the market goes up, we lose money on the cash lumber that we sold you and we make it back on the futures. That's the theory. And when the market goes down, it's vice versa. We make it on the cash lumber, we lose it on the futures. So that's why the price is fixed and it doesn't get adjusted. One of the interesting things, or not interesting, but I would say unique with forward pricing is it's when we price it, we're looking at where futures are. Obviously, futures, as you guys know, are insanely volatile. I mean, just in the last 2 days, they've moved $80 a thousand. So when we quote something, it is based on where current futures are. We'll often put a little bit of a cushion in it, but it's not a situation where, we'll quote this job and it's good for the next 2 weeks. In some cases, the price will be fine in 2 weeks. It might actually be lower, but in a lot of cases, it'll be higher too. So that's just really important that the customers understand. A lot of times it's obviously a process. You got to quote the job. They got to look at it. They got to come back. You got to requote it. It's a long process. And so, but using this kind of pricing, basically the quotes they're as good as long as futures isn't up, essentially is how it works. But we try to be flexible and, work with people. And really 2020 was sort of a testament to the program. I mean, will you ship if the market gets crazy? Obviously there's been insane turbulence in the market. There's been a lot of people that I've heard of that have essentially walked away from orders that were placed. A lot of drama of stuff not shipping when it should. So the deal is with us, you're going to get the wood. There will be times where the mill might be a week or two late, or, I'm not going to say everything is absolutely 100% perfect all the time, but like, you're not going to have any problems or drama with us getting the wood. I mean, we lock it in with futures where we've been doing this a long, long time. Just in 2020, I have customers that are, I'm shipping cars $500 a thousand to these guys, car after car after car. It's enormous volume. So this isn't a deal where it's like, this is like we're some fly-by-night guy and the market's up and now we're in trouble and we're going to give you a bunch of stories. It's like this is a program that is going to go through good and bad times and you're going to get the wood. So that's not going to be a problem. Let's see, Kyle, am I missing anything here?
No, I think the biggest thing is, in this, and I apologize in advance. I do have an unstable internet connection today for whatever reason. I don't know, but so if I break up, just please tell me. But the biggest thing is consistency. I mean, we really focus on trying to make sure that we have the product allocated, the product reserved at the mill level and scheduled in the time that the customer needs it, because you're making a big commitment to a forward price for this period of time. You want to make sure that you have the product in good, bad, or indifferent. And I think 2020, with a major supply challenge, yes, we did have some issues with things being a couple weeks late here or there, but we weren't stopping jobs because of it, and we were communicating with our clients all the way through. We need to prepare. We need a little bit extra time. Be prepared for these possible disruptions, but we have this wood purchased in anticipation that these jobs are going to go for this period of time. And please let us know. I mean, the COVID environment created a lot of delays, and then it created a tremendous surge. And through that time period, the majority of our guys, I really don't know one that was ever stopped for any period of time and was able to continue to conduct their business. And we've extended some shipments, obviously, because of the COVID disruptions last year, because jobs started late and so forth. What Steve said, we're shipping probably some of the last cycle of the $500 wood, but there's quite a bit of it still left on our open book of business that we're going to continue to deliver here in the first quarter. And a testament to those customers and clients that secured those jobs and were able to go out there and take care of their customer over that period of time. Because if they didn't, they could have been paying $1,500, $1,000 for it this time and replacing it. So it's something that we really pride ourselves in, making sure that we're going out there and providing that opportunity to them. And I think the biggest thing is not just locking in the price because we fear that the market's going higher, but locking in the price and not having to worry about it, not having to worry about cash flow, not having to worry about inventory degradation and any of those things. This really just provides a more fluidity supply chain into the marketplace.
Yeah, and I would say that, the vast majority, and we're selling a lot of different types of accounts on these programs. There's manufacturing clients. There are some lumber yards that have that where they're using it for inventory, but the vast bulk is multifamily. It's guys just like you, because it's just a perfect tool for what, not every day in, day out, but there's just times where it makes absolutely perfect sense to do this. So that I would say probably 80+% of our business it's multifamily guys. And I mean, a lot of you guys on the phone call, are already using it, but it's incredibly valuable, and that's where most of it goes. By the way, if there's any questions or anything, I have everyone muted, but I could unmute, or I think there's a chat box feature you could use. So I want to keep it, as interactive as possible. If you guys have any questions, see if I can unmute your office there.
I have a question. This is Kurt.
Okay.
It's probably been addressed with people that have dealt with this in the past, but I've not. When we're looking at forward pricing, what is your time frame? What are you looking at? Are you looking at forward pricing for a job that starts in 60 days and has a 6-month duration? Or are you looking at a project that it has to be at least 6 months out for this program?
That's a good question. Yeah, no, that's a good question. Well, really, we're doing all of it. I mean, we're, not only forward pricing, but we're doing, the traditional distribution, lumber broker, wholesale functions as well. So a lot of times it'll, for example, right now, I view forward pricing right now, frankly, as, probably April and beyond. I think anything that's, February or March is that's more of the cash market with where the order file is. So if you brought me a job, and let's say it started in March and it ran for 3 months, I would just do a blended price where I would use what the current market is for the front end and the forward pricing for the back end. We can accommodate all of it, is what I'm saying. Traditional forward price, using a model like this is, it usually is something that starts 3 months out and spread out over some period of time. There are times when it's just all bulk ship and one distribution. It might be jobs in July and it's 20 cars and it all ships in July. I mean, we do that stuff too. It really depends on, we cater it to what your requirements are. But in terms of the front end of it that might not be forward pricing, I mean, we're servicing that too, just through our normal, normal business. So we can kind of accommodate all of it, if that makes sense.
Steve, how do you guys deal with shifts in start dates and finish dates on jobs? That's a pretty common occurrence that we see, right? There's always some problem with permitting, or something is holding the start of the job up, whether it be permitting or weather or whatever. It's not uncommon for us to see jobs get pushed out 30, 60, 90 days sometimes.
Right. So the key there really, and we do a pretty good, we do a great job of this, it's just the communication with, so like that would be the communication of your sales guy, of the, the IdaPac guy with us essentially. If it's direct car loads and we haven't purchased it yet, like a lot of times you'll have heads up, you'll know a few months in advance that this might be happening, right? And so as long as we're communicating it, then typically what we would do in most cases is we would roll our hedge position into a further out time period, which would reflect when the job's going to ship now. And provided we can do that for no cost, then typically there wouldn't be any cost to you guys at all. There are situations, particularly when the market's on the low end of the range, where the futures back months are premium to the current market, in which case there might be a cost. So that's pretty straightforward as long as we're having good communication up front and it's wood we haven't bought. Now, if it's wood that we've already staged, let's say it's I have some in Texas with you guys right now that's sold via trucks to the job. So we need to stage the wood there to have it for when the job starts releasing. Typically when we do a job like that, we'll discuss up front at the time of order, like a cutoff date where we'll say, okay, we're going to bring this wood in for you guys. We anticipate it shipping out by April. If for whatever reason there's a problem and, maybe at the end of May, we're going to need to bill you for it essentially for whatever we've already bought and put there, because that's wood we paid for and we're sitting on it. And so we would have to have kind of an out date on that. Usually we'll give some extra, extra time on it because we understand, the real world is, this stuff happens all the time. So we want to be as flexible as we can, all at the same time, not, we can't tie up millions of dollars for indefinitely either. So on wood that's already been purchased, we would typically have a cutoff date. On the other stuff, as long as we're communicating, it's really not a big deal most of the time to just push it out. And that happens all the time. Like you said, probably half the
it happens
job
all. Yeah, I just to add just a little more color to that too. Like, Steve mentioned the orders that we would stage in a market that we might not be servicing distribution out of district where we're servicing some of the jobs in the Northeast, Mid-Atlantic, East Coast, Gulf Coast, and stuff like that out of our current distribution footprint. It's a lot easier to kind of delay and not incur a tremendous amount of costs to the customer. In fact, we hardly ever have any additional costs because we always have inventory flowing in and out of those locations. The only cost that might be required there is if in a certain manner, like Steve said, where we had to roll the futures contract over at a premium compared to even money, where it
Sure.
be additional cost to do that. But if we're having good communication, in most cases, we're not going to have the fiber there until you actually really need it. And it's really the extenuating cases, really few and far between, where we might say that we have to require a cutoff date because the wood was brought in, the job was thought it was going to go, and it ended up extending out another 30, 60, 90 days until it started. And, it created, a much larger cash convergence cycle. And that's where, the two partners would work together to try to come up with a reasonable solution to that. Yeah,
the folks, your guys that have done this with us, but this is, it happens a lot, and it's usually not a big deal. As long as we're discussing it up front, working through something together, it's typically not a problem. We've never really had that issue there, as long as we all understand up front kind of what the parameters are. Then that way everyone's happy. We don't want any surprises. We want people to be coming back for more. So it's really important to us not just to like say whatever we have to say to get the order. It's like we want to be totally upfront about exactly how the whole process is going to work all the way through. Our experience has been that most of the folks that do this with us, it's not like a one-hit wonder. I mean, these guys, once they start incorporating this kind of trading into their model, they come back and they're doing it pretty routinely all the time. Certain markets, it might work, be more advantageous to do more versus less, but in general, once they kind of buy into this concept, I mean, everyone we're selling, we've been selling them this stuff for a long time. So, so we try to be good partners and work together is kind of what I'm getting at. And it's usually not an issue.
Right. The whole point is communication, and more information known up front. In most cases, you never have any of those issues.
Yeah, exactly. And the other thing that it's really, there's sort of a tale of, well, let me go to this here. Let's go to this next slide. I'm gonna kind of get into this. Risk management process and hedging considerations. This is some of the stuff here is more kind of, I would say, part of the consultative value add that we can do. We look at a lot of different things, and we can be very helpful in terms of the timing. And the number 2 here is really important. Futures-based pricing moves differently than cash. Don't try to buy the same way as cash. This is something where we can help a lot. What I see all the time, and I know I'm preaching to the choir with you guys, but I'll just, this is what I see. Futures is a leading indicator. So let's say, let's just take the case of what we just experienced over the past, 2 weeks. Cash got toppy, it started to get a little spongy. Everyone pulled back, no one wants to buy anything. And the thing is, futures was like $250 ahead of that. So futures was already essentially at the bottom. So what happens a lot of times is guys will try to buy forward pricing in futures the same way they buy cash. In other words, cash gets toppy, it starts to fall, everyone pulls back, no one wants to buy anything, then it'll firm, it'll start to go back, it'll start to tick back up, and then I'll get like flooded with forward pricing increase based on that, because that's traditionally got what, the way that guys would buy cash. They're going to wait for print to stop going down, they're going to wait for it to start ticking up, and then they're going to pile in. And that's fine. But the thing with futures is it's a leading indicator, and it's way ahead of that. So, take the current example of the last 2 weeks. Futures has already bottomed. By the time cash firms and starts ticking up, futures has already moved over $100 a thousand. So why I mention this is, we can be really helpful in terms of the timing of that, because really it's 2 different markets. What's going on in cash at any given time is certainly very important. But when you're looking at executing a trade that might be 6 months out for a forward price, it's really, you have to become a lot more adept at looking at the futures market and some of these other things independently of what cash is doing at the time for structuring the decision. So a lot of the things, the value add that we can offer is certainly, you guys are like really good buyers. Like I see what you guys do, you're super sharp, but like we can help with a lot of the timing decisions based on some of this long-term stuff that's more futures based, because it really does trade differently. And I think it's important to understand that. And that just gets back to looking kind of at the big picture, look at the long term. We're going to talk a little bit more about fundamentals and technicals on the next couple slides, because I think that's really important. That helps us guide a lot of our timing decisions. The bottom one here, aligned with the right partners, is so important. There's some good players out there. I mean, I think we're one of the better ones, but there's some other good ones too. But the key is with this kind of trading, it's so different than buying like a car of lumber to ship in a week. You have enormous counterparty risk when you do this stuff, and we do too, frankly. You have to trust when you're placing these orders with us, where essentially you're trusting us that we're going to deliver what we say. Because if the market's up $500 a thousand, is a bunch of drama, and your customer expects you to ship, and the guy you laid it off with is not performing, I mean, you have enormous risk. So this kind of stuff, you really have to align with the right people that you trust, that have the track record. And the same with us. I mean, we have to trust that if the market's down 300, that we're not going to have a bunch of drama. And you guys obviously have, no issues there. And And we've never had a problem in that regard, really, with anyone, because we vet our people really well. But it's really important with this kind of stuff. It's a lot of people view it transactionally. I'll quote a job. It'll be an extensive list of stuff. It ships in 8 months. The guy will say, hey, if someone did it for $5 cheaper, someone who isn't as well versed in this business. And that's fine. That's great. Until the market's up 500 and the guy doesn't ship it, then that $5 cost you $5. So I'm not saying there aren't other good players out there. There certainly are, but just understand that you inherently have more counterparty risk with this kind of stuff. And so it's really important to align with the people that you trust, that are going to come through for you when you need it the most. So that's important. And also here, I'm skipping around a little bit, guys. I apologize, but make sure your goals are aligned with what the program is designed for. Day in, day out, forward pricing is not designed to buy cheaper than the market every time. That's really not what it's for. There are certainly times, if you time it right, you execute correctly, where you are going to buy cheaper than the market and you're going to pick up huge margin that way. But day in, day out, that's not what it's for. What it's for is, this philosophy of just minimizing your ups and downs and smoothing out and just earning your consistent 8% all the time, versus the crazy ups and downs. So just make sure what you're trying to get out of the program is what it is designed for, so that's important as well. Yep. Any questions?
So just so everyone knows, you can unmute yourselves. Steve, you can't unmute them. They'll have to unmute if you have a question.
Yeah, if you want to unmute yourself and just fire away as we go here. I don't want to just be, preaching. If there's any questions, I want to make sure and address them.
Steve, as long as you don't have an index to work with on OSB, you guys will just continue to kind of stay away from that.
Yeah, Kyle could speak to that a little bit. In areas where we have a large distribution footprint, like in the Northeast, oftentimes we will do forward pricing on it, because we can essentially use our inventory position as a hedge. The other area would be on some of the import products that we bring in that have extended lead times. Like the panels we were talking about yesterday, are essentially 3 months out. So that's sort of like forward pricing because of the transit time. But in terms of a model to use futures to hedge OSB consistently across the country, it doesn't exist. So I say we do stay away from it. We're active in the cash market on that stuff. So just normal, hey, we have a car for 2 weeks out or whatever, we do that. But I'm not consistently pricing large jobs with OSB for way down the road. There's no way for me to protect myself, unfortunately. I wish there was. There used to be a futures contract on OSB years ago, a long time ago. But I don't think it really took off, and it was delisted. So
yeah, it died off for lack of participation.
Yeah, no one traded it, right? And so that's unfortunate. Hopefully something like that will come back. We're trying to get more trading. I mean, we like doing these webinars, not only just to advertise what we're doing, but we want more people participating in these markets, in the futures markets. Having more participation and more people, more liquidity, it's only good for the whole marketplace, because then you take out some of the volatility and people start to understand it and get a little more sophisticated. So that's sort of, I would love to have something like that available in panels. Maybe we'll get there someday, but not right now, unfortunately.
Boy, if you could do that with OSB, that would be huge. It really would. I
know. They need it more than anything, really. Well, not anymore, but I mean, panels are crazy. And it's total cowboy style. There's no way to protect yourself other than just buying a bunch and sitting on it. And it's very capital intensive. I mean, I don't have to tell you guys this, so it's really tough.
Yeah, unfortunately, the only way you would get that is getting a lot of interest from the producers to create one. And I don't think they have very much interest in doing so at this point right now, because they don't understand it. Let's face it, the majority of the SPF and the lumber manufacturers don't really understand the futures contract as it is. Otherwise, we would see open interest, back heyday back in the day in the early 2000s of 11,000 plus. Today we're lucky to get 3,000 open interest in what we have in a lumber futures contract right now. Everybody looks at it. Everybody's making decisions off it. Almost the majority do not trade it. So it's very interesting in our marketplace. We talk about it all the time, and it sways so many decisions out there, but the vast majority aren't participating in it. I mean, it is a concern of ours, quite frankly, because if we don't get more people in it, that contract too will go away. I mean, just to put it in perspective, Steve, what's an average open interest of, let's say, oil or any metal or grain?
Oh, I mean,
comparatively,
hundreds of thousands, if not more, and lumber's 2,000, or whatever. So it's very difficult
right.
too. It's tough for us because we're I mean, legitimately, we're one of the largest players out there in this stuff. There's some other big players too, but there's been times when we've been a frighteningly large percentage of the open interest, which is very difficult because if we need to go move a position of that kind of size, you can't. It takes, weeks of chipping away at it here, so it's challenging. So we're trying to get more participation overall because and the industry needs it. I mean, that's the thing. We're not like snake oil salespeople, like not, going door to door of like selling some crap that people don't need. Like this is like people need this stuff. Like and really looking at 2000, I mean, it just underscores why it's so important, and people are certainly, I mean, you guys have been on it from the very beginning. Some of the other people are starting to embrace it more. I think it's going to really start to catch because of just what we've experienced. But it's, we definitely need to see more participation in these markets for sure. There's a lot of discussion about the futures contract, potentially them, listing a Southern Pine contract. There's discussion about changing the delivery on the spruce to blend Eastern and Western together. That's not anything that's going to happen anytime soon, but there's people are like discussing this because the bottom line is we got to get more people using it because it's a super valuable tool. I mean, any other industry, big commodity, industrial industry dwarfs what the lumber industry does in terms of using this kind of protection. So anyway, that's my little soapbox.
Yeah. I would just add, I sit on the CME's advisory for the lumber contract, and the one thing that is probably more likely to happen in this calendar year is the changing of the deliverable of the lumber futures contract in adding Eastern Canadian SPF to it. So that's probably very likely that could happen late third quarter, early fourth quarter of this year, but we'll have to see. It might actually blend into 2022, but that seems to be very, very likely. And there's a lot of talk of Southern Yellow Pine as well, because there is definite interest also. So it's something that's good, but to Steve's point, any way that we can get more participants in it, even if it happens to be we have to participate more in it, it's going to be better because we want to create more liquidity. The fact that lumber futures trades limit moves like that, it's not a good thing. It's because the whole thing about lumber futures is price discovery. And if you don't have enough people at all levels willing to go out there and pay it, you're going to have the volatility that we've experienced. But I will say, since they've expanded the limits from the old $10 a day to $15 a day to where they are now of 32 and 48, it creates more liquidity than we've ever seen before. You got to either accept it and like it, or get out of the way. More people have chosen to get out of the way. That's unfortunate, but we personally like it because, like Steve said, we have some big positions to move, and when our positions are 10-15% plus of the open interest, we want to be able to get out when we want to be able to get out, and if that requires a limit up move in one way or the other in order to do it, at least we're able to do that and reassess, and then ultimately go out there and make the next move that we need to make the following day or week or month.
Yep.
Right on.
Anything else?
I would just throw out there, this, in our terminology, this forward business, we have distributors that we'll call it a laid off job, right? Mm-hmm. So it's a job that's sometime in the future, and in spots around the country, we can take it to different distributors and or brokers who may have interest in taking that risk, that forward business from us, right?
Yeah, for sure.
Um, That's obviously hit or miss, and you guys, with what you offer, we can cover a whole lot more range in doing forward business this way with you. So it kind of opens things up a little bit more. So I would recommend to anybody who's looking at volume, especially that's out there a ways, use these guys. Run it by Steve. Make sure you're aware of this tool and that you're using it. We have, as you can imagine, we have taken, everything we do is short, and we took plenty of business last year short and paid the price for it, right? We're diverse enough and as a company that we made it through 2020 and we'll make it through 2021, but definitely rough waters. But, for forward stuff, especially that stuff that we get more and more customers that are asking us, hey, I want you to quote this for 6 months, 8 months, a year down the road, even longer than that sometimes, when you take into account the duration of the job. That's a big risk. And this is a tool that can be used. And I would highly recommend that anybody who's got business that's sizable and that far out, definitely run it by Steve.
No, I appreciate that. I liken it to like, your 9-iron in your golf bag. I mean, you're not going to hit every shot, when you're golfing with your 9-iron, right? But you want to have your 9-iron because there's some times when that's the club you need for the shot you need to make, right? So I sort of view it like that. This isn't the end all be all. We're not trying to like change the way you guys do your business, top to bottom, but this is an important tool. I think, especially in the hyper competitive and, consolidating markets that we're in, plus with that, with the crazy volatility, is like, you just have to know how to use all the different tools that are available to pick up all the little edges, over time where you can make more money. And so this is one of them. And and we'll be honest of what we can and can't do. You'd mentioned some other distributors. There are some markets where a job might be a smaller job. It might be highly mixed. It might be in a region where we don't have a strong distribution presence. And I'll say, hey, this one we're not gonna be able to help you with, XYZ might be a better fit. And, we'll definitely be upfront about that. But for the bulk stuff, the big volume commodity, that's kind of right up our wheelhouse. And, our book has done nothing but grow. And it's been a turbulent time for us as well, managing this stuff. Frankly, it hasn't been a lot of fun the last year, but we're not shying away from this at all because we know how important it is for the industry. So anyway, I appreciate the plug, Scott. And that's we're going to keep doing what we're doing. So I'm going to move to the next slide here. Kyle, you want to talk about this? We're going to discuss a little bit about briefly just sort of our read on the market, where we think things could potentially go. Just to kind of open that up for a little bit of a discussion as well. But Kyle, why don't you take this one?
Yeah, so I think it's kind of really leads into kind of what we were just talking about a little bit. I think in the way that I measure IdaPac and the way that you guys buy, and the vast majority of the people that buy in our industry, they are experts at analyzing the fundamentals of the business. They understand what is happening in a 60 to 90-day period inside of the marketplace better than anybody. So to be able to go out there and short, to be able to go out there and speculate long, and to go do what they need to do, they are unbelievably good at analyzing the fundamentals. But when you go beyond 3 months and you go into the next quarter or 2 quarters out, it becomes much more difficult to analyze what the fundamentals are going to be in that given period. And specifically what we've experienced in 2018 and 2019 and 2020. 2019 was a little easier because it was a grind higher, but 2020, when you had clear supply disruption, it was very important to look to add in, those technical indicators to kind of see, how real is this? Is this the new norm? Everybody talked about that. Is this the new norm? But we'll show you where we believe it actually is kind of the new norm until we see a little bit more balance of that supply and demand curve. But, the fundamental analysis is looking at all of the items that you have and trying to put an intrinsic value, really to understand for layman's terms, is the product undervalued relative to what I can buy in the future, or is it undervalued relative to what I think I'm going to be able to buy in the future? And then you tie in the technical side of it, and really just trying to determine inflection points when a market turns from one direction to the other, and then ultimately what the momentum is of that move. Then you can become a much more informed buyer and seller. That's going to allow you to sell product at a much higher price than you ever thought you could, and it's going to allow you to buy product at a lower price on average than you ever thought it would. You know, I think what Steve can provide to you and what have you is an opportunity, if you ever saw one, is to you look at all the negatives that you wrote over the last 3-year period and said, boy, if I could cut those in half, or cut those by 70%, or cut those by 100%, and then on top of it, just not even just to break even, but to put a profit on it, and then what would that have done to my bottom line? We're really trying to flatline that risk table for you. But knowing that you, more than anybody, probably have a higher level of risk tolerance than some of the other people in the marketplace, and we want to make sure that we align a strategy to kind of fit that opportunity that might align in certain markets versus others. So, Steve, you want to go to the next slide? And again, I apologize if I'm breaking up again. Hopefully not too bad. One of the things that we talked about in one of our former webinars, we've talked about in multiple ones, but the one specifically in September of 2020, we talked about the great lumber shortage post COVID-19. And one of the things that I want to talk about is that we were going into a lumber shortage, whether COVID-19 happened or not. The change from the way the marketplace has moved, and the millennials moving into a family formation, and the high liquidity or high monetary policy that's thrown into the market at low interest rates and so forth, was only setting us up to go out there and do what we've just witnessed today, 1.6 to 1.7 million housing starts. We probably got there faster than we were before because of COVID-19. You know, COVID was that accelerant, but in all likelihood, by the end of 2021, we were going to be up at these levels regardless. And one of the things that we noticed was analyzing at that time and looking back in history is, you know, everybody was trying to tell us that this is the new norm. No, it's not the new norm. We're just going to fall back to where we falled back before. But I kind of started to think about that, and it's like, what if it is the new norm? And is there any relative data or historical data that could help me support that technical analysis that it is the new norm? So what I did back then, actually, it was late third quarter 2020, was kind of look 30 years back and say, you know, what phenomena happened in that 30-year period that might be similar to what we're experiencing here in 2020. And one of the things, two data points that I looked at, we look at moving averages a lot. And I wanted to compare the 1 year. I started looking through, and after going through a lot of different things, I found two data points that I felt really were instrumental in kind of indicating of what we were possibly going through at that period of time. And that was the 1 year and the 2.5 year moving average. Some of you might hear the word the 200-day moving average. That's a big thing in stock trading. That's the equivalent of the 1 year, right? And then so forth and so forth. So one of the things that we looked at was when this phenomena happened, when the 1 year moving average moved above the 2.5 year moving average. And in this chart, the 1 year's indicated by the red line, the red curve, and the 2.5 is, I'm sorry, the 1 year is by the green curve, and the 2.5 year is the red curve. So when you see the red or the green go above the red, it happened 7 times prior to 2020. And in those 7 times that it happened, it created a bull market run that lasted an average of 24.7 months. And this happened most recently in July of 2020, what we experienced last year. So you can see that we're only in month 6 of what would be a similar cycle in the last 30 years. So we're very, even though we've had huge volatility here in the first, 6 months of it, the likelihood that it's going to continue for longer is much greater based off of what we've experienced in the past. And on top of that, when we analyzed election years, in every one since 1980, every election year, at the election point of November of the previous year to between July of the following year, so the first half of the following year, every market created a new high. It didn't matter if it was a Republican coming in. It didn't matter if it was an incumbent moving back into office. It didn't matter. It's like everybody took their money off the playing table and then started to put it back in after they found out who was elected, and the market took off and then ultimately recalibrated after that. But what it's telling us is that, yeah, add that on top of it, plus we have all this monetary policy, we're going to be in this push-pull market for at a higher range for a period longer. Steve, you want to go to the next, before I go to the next slide, any questions?
No, I think that's really good information.
You can see that looking at moving averages, just kind of as an aside, is actually a pretty valuable tool. The inflection points would be where the two cross, both up and down. You can see that in most cases, looking at the big picture, when they cross both up and down, typically, that move will extend for a while. And, there's no guarantee that there's no guarantee of what's going to happen. Anything, every market's different, but this kind of analysis certainly points out that, the likelihood of us staying in this, crazy environment, it's not a trivial likelihood. I mean, it's, there's a strong possibility that we're going to be living in this world for a while, which is, I know, depressing, but it's just a reality. And so that's okay. So we just have to plan accordingly, right? And so anyway, it's pretty interesting info. All right, here we go. Sorry.
Yeah, no, it's great. Scott, any other questions from your side? Yeah, no worries. Scott, any other questions on your side?
No, will you guys, can we get a copy of these slides after?
Yeah, and I think we're recording it too, actually, so we'll send you a copy of that just if you guys want to review it later.
In case we have trouble sleeping tonight.
Yeah.
Yeah, I'll put it on YouTube. I'll put it on YouTube for all your viewing pleasures at any time in the night.
Fascinating.
So
we kind of geek out to this stuff too. I mean, Kyle really, I have a pretty strong chart background, but Kyle kind of takes it to a whole new level. So, if any of your traders ever, I mean, we're happy to dive into this stuff. Really, we have this kind of data, not only just on the overall market, but we have it on every specific item. And so we're happy to walk through anything you guys want. We could create any custom reports or anything you guys want. Like, we're here to help. So I'll just to throw that out there.
Thank you.
Yeah,
sure.
Good stuff. So this is a weekly, daily continuation chart. So it's looking at the January as it rolled over into the March contract, and this was about 8 days prior to the January expiration. So we showed this chart to our webinar last week that we had for forward pricing. It's just kind of an indication of what we look like when we're trying to plan inventory purchases, when we're trying to go out there and offset risk on a forward pricing basis and what have you, and trying to pick points where we want to enter and exit. And this just kind of really tells a lot of one, what we were thinking at that time, and now what we're experiencing today. I'll just read it quickly if you can see it. But what we're talking about is January, there's 8 days trading length. March is currently $220 below the January contract and $280 below the current midweek print. That's what Steve was talking about earlier on this webinar, that seeing futures is a leading indicator, right? Like, it's going to find a price up to the upside and to the downside quicker than the cash market. It's all about price discovery. It's going to go and push the extremes all the time. And when you have a market with the volatility that we've experienced in the last 6 to 12 months, it goes in chunks that we've never seen before. But that's part of the world that we're living in, and it's going to be like that for the foreseeable future. But what we said back then was this market has two options. Number one, the discount is too large. the seasonal strength is too good, the fundamental strength overrides, and mills will come to the market building more order file, and the market finds support at the 100-day moving average. In this chart, I had it as the red curve, bouncing quickly off 640 and then racing back to 750. Or number two, the technical pattern is too strong, meaning that where price discovery will continue, and the March contract will continue to sell off towards the 200-day moving average, which is the green curve in this chart, which at that time would have been roughly 525, 550. Both patterns, I want to be clear, both patterns are bullish. They feel like there's like the second one is really bearish and what have you. But as you can see, that black trend line, it still confirms the backfilling motion of what prices do when markets move higher and lower. And this would continue the bullish trend. The one at the top, which number one, which we're talking about, probably is more bullish than we would suspect the second one. But that's just the way it is. And now today, just to give you an example, Steve talked about it, we've seen roughly an $80,000 move in the lead futures contract in the last 2 days, 3 days. And now we're essentially sitting at just under 750, right? So those two options, one of two was going to happen. And guess what happened? Number one, the fundamentals were much better than we thought. We had less inventory than we thought. We could stay away from the market in order to go out there and get the price down to 525. And the mills were willing to play. They went and played. They found the market very quickly at much higher levels than what the board was indicating. And that's why we're seeing the board back to where it is today, just under 750. Yeah. And if we close above there tomorrow or somewhere north of 700 tomorrow, I always look at weekly closes as kind of a real confirmation of momentum. All the moving averages roll over into what would be deemed as a buy signal. So it's again, just confirms a continuation of this pattern that we were talking about that we really felt was the new norm back in third quarter of 2020.
Yeah.
Any questions?
No, it's great info.
Yep. Now it just confirms that we're in this, we're not going back to normal. I mean, we're in this environment here for a while. And so I think it just underscores the stuff we were talking about in the beginning of understanding, now that we recognize that we're in this new paradigm of like, how are we going to operate our business a little bit differently, given the hyper volatility that we're probably going to most likely continue to experience, unfortunately, which is going to, necessitate different tactics from what's worked in the past. And so I think the charting just sort of underscores the whole point of some of the forward pricing and the tools that I think are out there that people, need to take a look at. So that's just, I think it kind of brings it all back around. So, we didn't really have anything else prepared. We're certainly available or, welcome to have any kind of discussion. I mean, of what you guys are thinking or anything like that. Questions, kind of open forum to just go over anything you guys want.
No, we appreciate it. I think we're a little over an hour now or close to that. We'll probably cut the team loose unless they have specific questions. Anybody needs Steve's contact info, please reach out to me, but most of you probably already have it. Kyle, appreciate all the information. I find your charts to be pretty fascinating, a little depressing right now, but pretty fascinating. And appreciate everything you guys do.
Yeah. No, we appreciate you guys taking the time. We know it's crazy right now and how we get it, but thank you for listening and we do appreciate all the business that you guys have given us and, certainly here to help do more stuff. So thank you very much.
Right on. Thank you guys.
Thank you guys. Really appreciate it.
Okay. Take care.
So we can trade swaps.